For an example, we have price action as a strategy. We have insider, be the market maker. We have the smart money concept, and there are also other strategies that people use that I don't even know their names, but that's not the problem, and that's not the case for today. Moving on with our subtopic, why should one have a trading methodology, right? We should have, or you should have a trading methodology, one, to put the odds of success in your favor. Two, to eliminate guesswork. Because when you don't have a proper methodology or a proper system that you are following, when you take your trades, you're going to take them based on what? On guesswork. The other point is to execute trades without fear, hesitation, and less emotions involved, right? So the reason why we should have a methodology is so that when we execute our trades, when we enter our trades, we enter them without fear. Why? Because we are trading systematically. We are using a system. We are using an edge that we know that if we take a series of trades, whether it's 10, 15, 20, we know that out of those 20 trades, 50% going up will be profitable trades. So when we take a trade, we take it without fear, without hesitation, and less emotions are involved, right? So most of the times we hear people saying, when you trade, you need to trade without emotions. That's impossible. As long money is involved, emotions are involved, fear is involved. But here is the point. As people, we can manage our emotions. We cannot fully control them because emotions, they make us human. So we can manage them, but we cannot really like totally control the emotions. That's impossible. But we will try as much as possible to manage them. Why? Because we are using a methodology that has been proven. Okay, so moving on to the next part. What to consider when choosing a methodology, right? So there are things we have things that you should have things that you should look at when you are choosing a method, right? So the first thing is consistency. You need a methodology that has consistency when it comes to results. You need a methodology that can at least give you 50% winning ratio or even more. And I'm glad that there are strategies that have a higher winning ratio, more than 50%, right? The other point is flexibility. Can you trade your methodology? Can you trade it when you have less free hours during, let's say you're having a 9 to 5? Can you trade using your methodology? Does it allow you to enter or to exit trades with the little time that you have? Then we move on to another point, which is efficiency, right? Can you trade your strategy in all market conditions? Because what you should know is that the market is not always trending. Sometimes it's ranging, sometimes it's chopping, right? So the question is, your methodology, is it efficient enough to be profitable in every market conditions? So those are the things that you should look at. The other point is simplicity. You should choose a methodology that is easy or simple to master. But what you should bear in mind is when we say simplicity, it doesn't necessarily mean that it's easy. It's not like that. But when you practice, it becomes what? Simple, right? So you should choose a methodology that is easy to master, and to apply, right? The other point is, does it resonate with your risk appetite? When we are on this one about risk, as people, we are different, right? Someone is comfortable with taking let's say 20 pips. Someone is comfortable with taking a trade of 30 pips, 40 pips, 60 pips, 100 pips. So the risk appetite, it influences your what? Your methodology. So you should consider your risk appetite, right? Okay. So let's move to the next what? To the next subtopic. Why do traders, or why traders fail when having a good what? A good methodology, right? So it's possible, very, very possible. You can have a methodology that has 90% or even more, 95% winning ratio, but you fail to profit from that methodology, right? So let's see why people are failing, right? The first reason is the inability to understand that every price action is unique, right? Not understanding what is moving price, right? For an example, let's take for an example on this one. The problem that we have is we are not in acceptance that every price movement or price action in the market, it's a unique event, right? We do not like to believe in that way, right? But then let me try to explain a bit on this one, right? The point is saying the inability to understand that every price action is unique, not understanding what is moving price. So it's of paramount importance to know or to understand the forces that are moving what? Price. What is making price to push up or to push down? And why is price what? Price is unique. Okay, so here is what happens in the markets, right? For an example, let's talk about the Forex market, right? So the Forex market is the largest market under the sun, right? We all know that the market cap is about 6 trillion. It's about 6 trillion US dollars in a day, that moves in a day, right? So here is how price moves, or what causes price to move, right? So we have a structure that we have in the Forex market. There are guys who trade the largest volumes. There are guys who trade the biggest equity that you can dream of, right? Then there are us, the retail traders. We have the smallest equity, and you know that retail traders cannot move the market. Why? Because of the equity that we have, right? But we have the big guys, such as we have the major banks like JP Morgan's, those guys. We have other institutions that trades large volumes, right? So we all know that in trading, in order for you to make money, you make money using these two ways. It's either you are buying low or you are selling high, right? Let's take for an example that let's say you have identified the highest price point, right? And you are saying, or you are having a belief that in this area, price is the probability of turning to the downside, right? So you are believing that in this moment in time, price can what? Can turn to the downside. But the problem that you have is you cannot move the market. Why? Because you don't have that liquidity to what? To move the market. You're a retail trader. So for price to turn, you need the big guys to enter the market. You need the big guys to share the same belief with you that price has to turn in this area, right? So when the big guys share the same belief with you, it means the market will what? The market will turn, right? So the reason why the market turned is not because of you, but it's because of the what? Of the big guys who have the same belief with you, right? So meaning that retail traders, we are not there to move what? We are not there to move price, but we are there to share our belief with the big guys who move what? Who move price, right? Let's say today you have spotted the highest price point and price turned in that area, right? The next day you have spotted the same price point, right? And you are expecting again price to turn and push to the what? To the downside. That is what you are expecting. But the question is, are the people that you shared the same belief with yesterday, are they going to come into the market and push the price to the what? To the downside? Are the same people going to come in? You will find that it will never happen like that. Why? Because the people that who took the same trade with you yesterday, the number of people that took the same trade with you yesterday won't be the same number of people who will take the same trade with you today. So already there is a variation. There is a great variation. There are variables there. Why? Because yesterday, a certain number of big guys who came in and push the price your direction, right, won't be the same number of guys who will come again on the following day and push price in your direction. They will not trade the same volume. You will not trade the same volume as yesterday. So already we are having what? We are having variations. So we are already seeing that, okay, every moment in the market or every outcome in the market, right? It's unique. So we shouldn't give a lip service to this idea, because that's how the markets are. So you can take a trade today with the beautiful criteria that you know of your strategy, right? And it can result into what? Into some profits. But it doesn't mean tomorrow that if you take the same trade with the same criteria, it doesn't mean it will result into what? Into a profitable trade. Why? Because the same forces that moved the price yesterday, there won't be the same forces that will move price what? Today. So you have to be in acceptance in that. You have to accept that. Okay. So I hope I've explained enough on that one. Okay. So let's move on. Why traders fail with a good methodology, right? Another point is less understanding of the strategy, right? So one can say, okay, I have chosen to what? To trade, let's say, beat the market maker method, right? But the question is, do you really know how to use the strategy? Do you really know how it works? If I ask you, what's your entry types? Can you tell me? If I ask you, how do you manage your trades as the trend is moving in your way or is moving against you? Would you tell me your exit points, how you exit the market? Because this is not guesswork, guys and girls. This is not guesswork at all. Okay. So the other point that I have is we have too much expectations from the strategy. So we expect a lot from the strategy, but you need to know, what you need to know is that it's not only about the strategy that will make you a consistent, profitable trader, right? You need a mental structure that is a concrete mental structure, right? That will help you with your strategy to make money. Because there are other factors or there are other things that will affect your trading, and your strategy cannot help you from those things, right? For example, right, you have entered a trade, right, and you take, let's say your trade moves about 10 pips in profit, maybe 10 pips to you, it's about $50, right? Let's say a trade moves 10 pips and you're in $50 profit, and you decide to close, right? Then you close the trade. And after closing the trade continuing going your direction, maybe it moves maybe 80 pips more, that's $80 more, and you are out of that you're out of that trade, right? Your methodology, it doesn't help you. Why? Because it's not the methodology that told you to close that trade. No, it's you. You closed on your own. So your method, it's not the problem of your methodology. It's not. But most of the times we accuse or we blame our methodologies that this strategy is not working, but most of the times it's us, right? So let's move on. Today, as I said, I'm talking about the strategy that I use. So here is it, guys. Here it is, guys. So we are going to talk about pure price action, right? So people, they know price action, but there is a difference that we have between pure price action and just price action, right? So price action, that's where we trade using a lot of things. Indicators are included there, the Fibonacci's, the stochastics, the EMAs, those kind of indicators. And at the same time, we are using trend lines, patterns, right? But with pure price action, we are only using patterns, we are using market structure, we are using psychology, and specific order blocks. This one is from the inner circle. This one is from ICT, specific order blocks. But pure price action, we are trading in the absence of what? Of indicators. We do not use indicators at all, right? But I'm not saying that you should trade my strategy. No, you should go out there, look for a strategy that works for you, look for a strategy that you think it's good for you, it resonates with you, your personality, your emotions, right? But me, I use pure price action. And for those guys who do not have a strategy or who are struggling with other strategies, it's your choice to make, to choose a new strategy, follow it, right? Okay, so we're gonna start from market structure, right? We're gonna start from market structure, and we are going to focus a lot today on the nature of price, right? Understanding how price, understanding how price moves. Okay, so price moves in two phases, right? It's either we are in an impulsive phase, or we are in a corrective what phase. So what do I mean when I say impulsive phase? Impulsive phase, I'm simply saying that price has momentum, right? Price is aggressive, or there is high volatility in the markets, right? So we are having those big candlesticks, right? So that's impulsive, that's being impulsive, right? Then it also moves correctively, right? That's when you hear other guys saying, the market is not moving, the market is choppy, the market is consolidating. So corrective, being corrective, that's when the market is what? Is moving sideways. The market is ranging, right? We are not trending. We are just moving in one what? In one position, right? Or we are just moving in a range, in the same area, right? That's being corrective. So we are going to the charts so that we can see what I'm talking about. Okay. Okay. So the chart that we are going to start with, with Bitcoin. We are going to start with the Bitcoin chart. All right. So let me find my marker. Okay. So here's how price moves, guys. So price moves impulsively, right? Then it corrects, right? After it corrects, after the correction, it forms a what? It forms a pattern, right? Then it continues moving what? Impulsive, right? So that's the first scenario that we have. Or price can move impulsively like this, right? It corrects, right? You can see that now this correction is different from the first correction, right? This correction is more like a reversal pattern. So it's impulse, correction, then impulse to the what? To the upside, right? So we are moving in impulse, correction, continuation. That's the first scenario. Or we are using in, or we are moving in impulse, correction, then reversal, right? So those are the two scenarios that we always have. Okay, let me clear. Let me clear the chart. Okay, so we want to focus a bit on what? A bit on Bitcoin here. All right. So we would start at the top there, at the top of the what? Of the structure there. We want to see how price moves from the top of the structure there, going to the what? To the downside, moving to the downside. Okay. Okay. So we had an impulse there. We had a correction here, right? We had our impulse there, right? Let me, okay. We had our correction here. Okay. Let me zoom. Okay. Right. So
Mr. Donald, just a bit.
uh,
So in case our Zoom session cuts off, can we kindly use the link to rejoin, because we only have 45 minutes on our Zoom per Zoom session. So if if the time expires, guys, kindly come back and rejoin. Soon as it expires, rejoin the meeting again, because there's a lot to share. So don't worry if the Zoom cuts off all of a sudden. Don't be scared to just rejoin again. You can continue, Mr. Dino. Thank you.
Okay, thank you. Okay, so we are seeing that price. Okay, let me circle that one. We are seeing that price is moving, impulse, correction, continuation, impulse, correction, continuation. But if we look at that price action, overall, we can see that that was an impulsive move to the what? To the downside. That was a big impulsive leg to the what? To the downside. Okay, let me mark it. So this is our big impulsive leg, right? But bear in mind that in that big impulsive leg, we are having corrections, right? So we are moving impulsive, corrective, right? But at the end of the day, we are forming one big impulsive move, right? So after forming the one big impulsive move, look at how then we form our next big correctional move, right? So it's impulse, we follow with our what? Correctional move. So you have to ask yourself, after an impulse, is the correction that you are having, is it a reversal correction or is it a continuation correction, right? So that alone, it will help you to determine where price is going next, right? So right now, I already know that, okay, so right now I already have an idea that, okay, we had a large impulsive move, right? Currently, we are having a continuation pattern. Price is it's being corrective, but we are having a continuation pattern. And I'm not surprised if Bitcoin continues pushing to the what? To the downside, right? So let's see what happened to Bitcoin, right? After the continuation pattern has been formed, right? Which is a correction, right? We can see that price okay. So price moved what? Impulsively to the downside, right? So what are we focusing on next? We are focusing on the what? On the next correction, right? Okay. I remember very well. I remember very well on Bitcoin. I remember a lot of guys, they were so excited when price approached this what? This support level, because we have a touch there, we have a touch there, we are having a touch here, right? So guys, a lot of guys, they were excited that now Bitcoin is to push to the what? To the upside, right? They were so excited. But then I wasn't excited about that. Why? Because we had an impulsive move, right, to the downside, right? And we started forming a continuation pattern on the what? On the support level, right? So a lot of guys, they were saying, okay, we're at the support level and this support level is strong, price has to push to the downside. But they are not looking, they are not following the patterns, they are not seeing the patterns, right? I still remember, let me clear my chart a bit so that we can see. Okay, so I still remember talking to another guy and he was so excited. He was like, now Bitcoin has to buy, but I was like, no, guys, look at that continuation pattern that we have. We still have to push to the what? We still have to push to the downside. And look what happened. After forming that continuation, what? After forming that continuation pattern, look what happened. Price pushed to the what? To the downside, right? Price pushed to the downside, right? Currently, we are forming another what? Currently, we are forming another continuation pattern. We are forming another continuation. We are forming another continuation pattern, right? Okay. This is another continuation pattern. So don't be surprised again when you see Bitcoin dropping again, right? Don't be surprised, because that's the nature of what? That's the nature of the markets. The markets moves impulse correction, right? You have to pay attention to the correction. Is it a continuation correction or it's a reversal what? Reversal correction, right? So let's move to another what? Let's move to another pair. Let's take another pair. Okay, let's take for an instance GBP USD. Let's take GBP USD. Okay, so this is the daily on GBP USD, right? Okay. Okay, I want to deal with the current what? current price action. I want to deal with the current price action, right? Okay. So we are on the daily, right? We are on the daily, right? We are having this impulsive move, impulsive push to the downside, right? So we know that when we have an impulse, it's either we are going to have a correction, a continuation correction like this one, and we continue to the what? To the downside, or it's going to be impulse, right? Price starts losing momentum, but moving to the downside, but forming more of a what? More of a descending channel, then it pushes impulsively to the what? To the upside. So those are the two scenarios that we always have, right? So it's crucial to study. It's very important for you to study your what? Your corrections. You need to know those patterns that are being formed. You need to know them. Okay, let me clear again so that we can see what's happening. Okay, so when we had that what that impulsive move, right? We paid attention on this price action, that on the current price action that we are having right here. We paid attention on this current price action, on this current pattern. We can see that the current pattern that we are having, right, it's not a continuation pattern. This is more of a reversal, what? Reversal pattern. And if you back test, you can go and check on your charts, wherever you see a channel descending like this, you're seeing price moving to the downside. What happens most of the times? Price always breaks to the upside, right? I'm not saying there is no the probability of price pushing to the downside. It's there, but we are saying the highest probability is to the what? Is to the upside, right? So it's very, very important to know your what? Your patterns. That's only if you are a guy who use what? Who use patterns. But what you need to know is patterns, they are very, very effective, right? Another thing that you should know, we are not just looking for patterns in random areas. We don't do that. We don't look patterns in random areas. I still remember it was the day before when I was talking about the psychological what? The psychological areas. So we are looking for patterns in psychological areas. We are looking for patterns. It's either on support, or it's either we are approaching resistance, right?